artificial intelligence continues to be the talk of the town among big players such as Microsoft and Alphabet, both of which had plenty to say on AI in their quarterly conference calls on Tuesday. Alphabet mentioning AI 52 times, and Microsoft coming in at 36 mentions, according to Reuters here. We were listening to these calls, Yahoo Finance was yesterday, and ultimately the amount of time spent, even though there were multiple mentions, dozens of mentions for both of them, it was the amount of time spent both in questions and also prepared remarks that was really kind of jarring to me, in that Alphabet knew that it could only say at least so much right now about the generative AI plays that it had, whereas Microsoft has already openly made a $10 billion investment in OpenAI. They have already seen this be proven through the search engine, or at least integrated into the search engine that they're trying to prop up and take some of the market share away from Google. Google and Alphabet, for their matter, I think that they were just trying to say, okay, yeah, we're not really concerned about how much the other players in the space are going to integrate this in. We're still going to do just the same thing, and then we're going to retain our market share on top of that.
Right. And as I wrote about in this morning's morning brief, basically all of this AI enthusiasm, right, and companies throwing out these terms over and over again, and we talked about this yesterday with the chart of the day, has really bolstered stocks this year. And that's caused concern among some investors. So let's talk a little bit more about that. Megacap crowding is how it's being referred to. It has been aided by the AI hype, according to some analysts. It raises concerns of leaving the overall market more vulnerable to turbulence. So what market risks are lingering in the shadows that could tip the scales for investors? Here to discuss this and more is Dave Mazza. He's Roundhill Investments Chief Strategy Officer. And Dave, you know, this is a concern that comes around perennially, right? Like the market is too reliant on tech. It's here. That concern seems to be here again to some extent. If you look at Apple and Microsoft alone, they account for something like 13% of the S&P 500, which is huge. Is that a risk here? Doesn't look like a risk today when the stocks are going up.
Not at all. What's interesting is, to your point, over the years, whether it was energy companies in the 2000s or financial services companies actually before the global financial crisis, and now again tech, folks get concerned with overconcentration when just a handful of names seem to be driving index performance. But what's interesting to me is if we take a step back and look at where the revenues are coming from, and again, Microsoft was actually able to put up pretty impressive growth in what was all to consider could have been a lackluster quarter. That's impressive, and that's why investors continue to flock to these names. I think what's more interesting is that this market appears to be a have and have-nots market. And I actually believe we might continue to be in this environment until there's greater clarity on the path of interest rates and the economy itself.
Did the earnings from Microsoft and Alphabet prove that corporate spending, at least, is still intact for cloud services right now?
Yeah, so the three things we were looking for heading into big cap tech earnings was one of those areas was around cloud services, around generative AI, and you just mentioned the impressive number of mentions in that space, and then just simply how margins were looking. And net, again, Microsoft, to a lesser extent Alphabet, proved to be pretty resilient here. These companies' business models are strong. They have wide moats around the area. I am more concerned about some of the smaller cap players in the space. They have been under pressure, particularly the non-profitable companies and investors who can see what they're earning on their cash accounts now. I don't think they're going to dip their toes in the water into riskier small cap stocks when they can say, hey, if I want to have equity exposure, let me stick to players that may be safer. And safety in this market is being expressed as big caps.
Especially when we're looking at these sort of hot areas, momentum areas, I'm reminded of an ETF, one of your ETFs in your suite, and that's the Metaverse ETF. Because last year at this time, that was all we could talk about, right? And you guys, along with Matthew Ball, who I think is one of the folks who coined the term the Metaverse, or certainly has written a lot about it, introduced this ETF. And it went up a lot. And then I'm looking at the past year, it's kind of gone sideways, right? So how do we, when you are trying to discern whether a trend is just a fad or if it's a longer term investable thesis, right, or idea, how do you figure that out?
Yeah, no, you raise a good point. And I think the Metaverse, and yes, our ETF METV is reflective of that, right? It had excellent performance struggled in a rising rate environment, but this year it's bounced back. It's one of the top performing ETFs actually in the U.S. equity market year to date, because I think investors are embracing the fact that companies have come out and said, this is the year of efficiency, right? As Meta famously has said, and that's probably become an overused term by companies in this market, but it's true. I think those companies that are focusing on their balance sheets, focusing on growing their top line prudently, but maintaining their margins are being rewarded. So investors need to take a step back and say, yeah, what is just kind of a passing theme that maybe just has some interest but doesn't have staying power? I can say, yeah, maybe the metaverse isn't happening today, and maybe that gets pushed out a bit. But the idea that companies are going to continue to spend there as we become more digitized, and the mixed reality and also advanced realities and things of that nature become more commonplace is not going away in any way, shape, or form. But to go to generative AI for a moment, what I think is important is every company is going to be mentioning this. We saw a massive number of mentions by PepsiCo and by Coca-Cola.
Right, forget about Microsoft and Alphabet that we were just talking about, right?
Exactly.
You can design your own can for a Coke or something using it.
And there may be a utility for that, but I think that's where it gets important to investors. Say, if I want to be in generative AI, perhaps I should focus on the companies that are investing in it, to your point, like Microsoft with OpenAI, what Alphabet, Google is going to be doing with Bard, and others, as opposed to just saying, hey, any company that mentions it 1,000 times, that's where the environment's going to be. So it takes a little bit more homework. This is not an easy market environment, right? Before last year, it was actually a relatively easy environment. So I think investors do need to do their homework and say, what are the companies that are actually investing in it? What are they really doing here? Is that R&D going to productive uses?
What are the top companies then that you would be fading? You mentioned not liking small caps right now, and I think naturally about some of the one-trick ponies in ERP or even some of the cloud tech plays right now.
Yeah, no, I think that's a great point. So we actually have another ETF, the Roundhill Big Tech ETF. Mm-hmm. This is focused just on the 5 big cap tech companies, right? So the FANGM stocks. Yeah. I almost believe nearly anything else doesn't provide you the potential certainty that you can get with those names that we're seeing with earnings. So I think non-profitable companies will continue to struggle. The interest rate environment is not changing here. I think many people were hoping for the pivot. Mm-hmm. I don't see a pivot coming, right? I actually think we might get another rate hike before there's a pause. The pivot is now the pause. So when we think about tech, it's not just a broad brush. It used to just be buy the NASDAQ, hold your nose, it's just going to go up. I don't care what the valuations are. I think in this market, we got to focus on companies that have that earnings, the potential with diversified business models. And that's really in the mega cap growth areas, even though in the intro to this segment, we talked about how much they are concentrated in indices. But that's where the revenues are. That's where the growth is. So it's relatively logical, even if their valuations have increased.
Yeah, maybe you can hold your nose if you're not going to sell for 5 years or 10 years or 20 years, but maybe not by the end of this year. Dave, thank you so much. It's good to see you. David Mazza is Roundhill Investments Chief Strategy Officer.